$32 billion vanished in a matter of days. The sudden collapse of the world's third-largest cryptocurrency exchange sent shockwaves through the global economy. At its peak, millions of users treated FTX as a digital gold standard, the single safest platform in an industry defined by volatility. Sam Bankman-Fried was the architect of that trust. He projected the image of a boy genius savior, but he eventually emerged as a fraudster of nearly unparalleled scale. While the public saw a fortress of financial security, the entire empire operated as a fragile house of cards, functioning with virtually no independent oversight. Bankman-Fried carefully maintained an anti-billionaire persona, appearing in cargo shorts and messy hair while playing video games during high-stakes interviews with regulators. He called his guiding philosophy effective altruism, a commitment to making billions purely to fund global charitable causes. This noble image served as a convenient shield against his critics. This curated character bought the silence and the capital of the world's smartest firms and most famous celebrities. At the height of his legitimacy, he spent $205 million for the naming rights to a major NBA arena, cementing FTX as a mainstream powerhouse. Major institutional backers essentially invested in a philanthropic crusade rather than a verified business model, seduced by a savior complex that promised their capital was changing the world. To protect investors, a crypto exchange must keep customer deposits strictly isolated from its internal trading operations. Mixing these funds creates a dangerous conflict of interest. Bankman-Fried ignored this rule. His supposedly independent hedge fund, Alameda Research, was run by Carolyn Ellison and remained inextricably linked to the FTX exchange. This connection was hard-coded into the platform. Bankman-Fried directed his engineers to create a secret software backdoor that gave Alameda unique, undisclosed privileges. This back-end diagram shows the allow negative code assigned to Alameda, granting a hidden $65 billion credit line. Standard users faced immediate auto-liquidation, but Alameda was immune, extracting unlimited customer deposits to cover its losses. Bankman-Fried effectively turned the exchange into a vacuum, funneling retail deposits into a personal piggy bank used for Bahamas real estate and high-risk venture bets. The empire began to fracture on November 2, 2022. A media leak revealed that Alameda's multi-billion-dollar balance sheet was propped up by FTX's own self-valued token, FTT, instead of hard currency. The rivalry between exchanges turned fatal when Binance CEO Changpeng Zhao, known as CZ, publicly weaponized the information. CZ announced that Binance would sell its $500 million stake in FTT, triggering a wave of global panic. The result was a massive bank run. Terrified customers attempted to withdraw $6 billion in just 72 hours. Users quickly discovered a devastating reality. The money was gone. Paisa tawan tahi nahi. Alameda had already spent the deposits. On November 11th, Bankman-Fried tweeted a final claim that assets were fine, then immediately resigned and filed for bankruptcy. A $32 billion empire collapsed in 9 days because its foundation was a mirage built on stolen cash and digital tokens that Bankman-Fried printed himself. Bankruptcy specialists brought in John J. Ray III to manage the cleanup. Ray had previously overseen the Enron liquidation and had a career-long view of major corporate failures. He found a global empire managed with the rigor of a small startup. Billions were tracked on QuickBooks. Executives approved massive money transfers using simple Slack emojis. The legal consequences were swift. Bankman-Fried was arrested in the Bahamas and brought to trial in New York. His inner circle, including Caroline Ellison, testified against him. The court eventually delivered a guilty verdict on all 7 counts of fraud, resulting in a 25-year prison sentence. The myth of the financial genius dissolved into a reality of amateur hour. A multi-billion-dollar empire failed because it lacked even the most basic accounting safeguards. Millions of ordinary retail investors lost their life savings in the fallout, while executives were busy accumulating $121 million in Caribbean real estate. Bankman-Fried weaponized a noble philosophy to bypass skepticism, using charity to mask extreme greed. The collapse of FTX provides a chilling lesson. In the unregulated world of crypto, your money is only as safe as the personal morals of the person holding it.